Good evening and a very warm welcome to the e-learning platform of ICAI. I am CA Neha Gupta, and on behalf of Internal Audit Standard Boards of Institute of Chartered Accountants of India, I would like to thank all the faculties, members, students, staff, and the guests present for gracing this occasion. Special thanks to all our dignitaries for agreeing to grace this event. ICAI, that is Institute of Chartered Accountant of India, was established under the Chartered Accountant Act 1949, passed by Parliament of India with objective of regulating the accountancy profession in India and is the second largest professional accounting body in the world. Today, we have gathered here to discuss on a beautiful topic, which is one of the very, very essential part and parcel of our profession. So I would now glad and would love to invite CA Shri Amit Kumarji, Chairman, Rewari Branch, who is hosting today's program organized by Internal Audit Standard Board of ICAI. Over to Amit sir for his welcome note.
Thank you, Neha ji. First of all, very good evening to all of you. I, C. Amit Kumar, Chairman of Rewari Branch of IRC of ICI, feel privileged to extend my warm welcome to present all of you in the today's virtual CPE meeting on internal audit and risk management, organized by Internal Audit Standard Boards of ICI and hosted by Rewari Branch of NIRC of ICI. So I, on behalf of entire audience, very thankful to all the management committee members of Internal Audit Standard Board for organizing such a wonderful webinar. We are also thankful to our today's speaker, CA Santosh Kumar ji, Ms. Dipti Barera and CMA Ram Prasad ji for giving your precious time with us. So without taking so much time, I would request from CA Neha Gupta ji to proceed further. Over to you, Neha ji.
Hello, everyone, welcome to today's session. I take this opportunity to welcome CA Santosh Kumar and Ms. Deepthi Barera in today's session. And now, I would like to introduce CA Santosh Kumar, who is the national leader at Deloitte India for Strategic Brand Risk and Sustainability Services. He is a governance, risk, and control advisory professional with over 27 years of experience in corporate governance, enterprise risk management, process transformation, and next-gen controls. Santosh has extensive experience in leading assignments related to development and rollout of ERM framework, reassessment, refresh of enterprise risk management framework, risk culture assessment, and crisis management. His expertise span industry verticals ranging from e-commerce, technology, consumer, hospitality, and life science to government and public sector. He has also worked extensively with board and senior leaders team in multinational corporations and advised them on governance, regulatory framework, its implementation, and related change management. Santosh was also a member of Empowerment Committee of the Institute of Chartered Accountant of India, and he played a role in framing the standards for IA board. Santosh has also contributed to the technical guide for audit of internal controls in India, and he is a regular speaker at industry association and other professional forum on matters relating to corporate governance and risk management. I would also like to introduce Deepthi Barera. She is a director with risk advisory practice of Deloitte India, and with over a decade of experience in risk consulting, she is the lead director for the enterprise risk management and corporate governance services. She is a management graduate and a certified corporate governance professional and is pursuing a doctorate research in the domain of strategic risk management. She worked extensively with the board and senior leader teams of global organizations across industry verticals and advising them on matters of governance, risk, and compliance. I would like Santosh to take this webinar forward. Over to you, Santosh.
Thank you, Shubham. Thanks for the kind words. When we share the profile, we don't realize it will actually end up taking so much time. So as a part of risk management, I must remember to probably make it briefer the next time. Thank you very much. Thank you, Amit, for hosting us and for giving us this opportunity to share our thoughts with this August gathering. Thank you, Arun, and thanks, Neha, for the introduction. And Aarti, thank you for all the coordination that you've done to get this program on board. So, Dipti, if you would share the slides. So while Dipti pulls up the slide, what we thought, Amit, if you're okay, is that, we will share our views with the gathering today, maybe take around, considering it's already 8:15, maybe 45 to 50 minutes, and then probably have question answer. I'm sure the audience will have lots of thoughts, viewpoints, and we can probably share that, discuss that at the end of the presentation, if that is okay. Yeah. So, Deep, you could move to the next slide. So, yeah. So, good evening, everyone. Thank you for taking out the time on a Saturday evening. We would try to keep this interaction with you fairly engaging. Hopefully, we will be able to share some insights on how we see this very important topic progressing. What we have done for today's conversation is broken it down into 3 distinct phases. I think one is to start off by giving you a lay of the land as far as risk management. I'm sure all of you are, you know what risk management is, you know what the expectations of companies are, but we thought probably we'll spend a little time just giving a quick refresh on the risk management concepts and where things are currently. More importantly, talk to you about what are the changes that we see in the landscape and what are some of the drivers of this change, why risk management has to be thought of, looked at and addressed by both corporates as well as professionals like us very, very differently going forward. And what really is the future of risk? How should we all now apply a different lens basis the changes in landscape on how we look at and address risks for the organizations that we work with or organizations that we advise. So that is what we will be addressing today. I know Mr. Ramprasad is coming after us and speaking to you on continuous control monitoring and internal controls. And risk management and internal controls go hand in hand. We will focus on risk management because internal controls is a program which is being addressed subsequently. Deepti, if we can move to the next slide. Yeah, we can move. Yeah. So, I said, we'll keep it a little interesting. So the shiny red car, it is an imagery that we use very, very frequently in our conversations with organizations. And this specific car, when you look at it, the first thing that comes to mind is the speed, right? And when you think of a very important feature that all cars need to have, are the brakes. And if you look at, and if you ask this question, and if you think yourself, the first thing that jumps to mind is, why do you need brakes? Is so that you can brake and stop when required. That, is the first kind of response that we've heard from most people. I know at the moment, I'm not able to engage you all in a live conversation, but just think about this. Is that the purpose of the brake? Is the brake there to stop you, or does the brake permit you to do anything else when you're riding at high speed, maneuvering curves, sometimes dangerous curves? And as you think about it, you will realize that it is more than that, right? It's braking, stopping is an important aspect, but because the brake helps you stop, it gives you the confidence of going much faster, right? So think of risk management also in a similar context. Yeah? Speed is important, but speed can also be a risk if not managed well. And brakes in a car help you control the car, help you maneuver, help you keep the driver and the passenger safe. Similarly, in a world which is full of risks, both internal and external, having bricks, which are nothing but risk management framework processes in a company's framework and environment, helps you navigate the risk landscape much better. So risk is not a bad word. Risk is a good word. It is good to know all your risks. So don't be worried about there being too many risks. If you're aware of all your risks, you'll be able to manage your risks better. And I always tell people that the flip side to risk is opportunity. If you don't understand risk and if you don't take risks, you will never be able to optimize opportunities, and hence you will never be able to grow. So I wanted to start this conversation today with that context, to say, risk controls everything is sometimes perceived with a negative connotation. I would urge all of us to expand our thinking, our boundaries, and say it is not a negative word. It is an enabler. It is an enabler for us to grow. It is an enabler for us to move at a rapid pace, at the desired pace, to meet the objectives that we have set out for ourselves. So with that, what we will do is I will turn this over to Deepti to walk us through, the risk management concepts. And once she is finished, I will come back and talk to all of you about some of the drivers in today's landscape, which are changing the entire view, the lens on risk. So over to you, Deepti.
Thanks, Santosh. So Santosh was talking about the fact that risk is always associated with a negative connotation, but we wanted to address that point and bring to the table what really is risk. If you have to look at definition of a risk, it is an uncertainty. It is an uncertain event or a condition which can have any kind of effect on achieving business objectives for any organization. And when we look at effects, we would want to highlight that the fact is that it can have both positive or negative effects. If managed well, you can exploit a risk which could be more calculated and look at rewards from the market. And if there can be scenarios where you self-inflict something on yourself or on your organization and manage to get a negative impact or a negative effect for a risk. We'll talk about in subsequent slides on these various categories and types of risk that an organization can face. But there are three important aspects that we need to keep in mind when we are defining anything that is called as a risk. So there are three key categories. It is an uncertain, probable event. It is not a short activity which has happened. There is an uncertainty in the future that something can happen. Good or bad, the effects can be decided upon, but it's always there is a level of uncertainty involved when you talk about a risk. The second aspect is that the effects that it can have on your business goals and objectives. The idea is that we measure our business goals and objectives and look at risks around that, both from a positive as well as a negative impact, and set clear definitions, goals, and criteria within the appetite of the business, which we can manage and live with those risks and come out stronger. So very clearly, three important points of uncertainty, positive and negative effects, and achievement of business goals. The entire aspect of us defining certain business objectives and then looking at risks around them is the premise of effective risk management, which is what we are going to talk to you about. If there are no achievements or no targets that we have, there will not be risks towards any of that. So wherever there are goals and objectives that are set up by business, there will be positive or negative effects that can happen, and thus there will be risks in achievement of those. So if we move further, we would look at what really is risk management. So we spoke about risk, which is an uncertain event. The idea is that the way uncertainty impacts our organization's objective. In a normal scenario, when there is no risk, where everything is going very, very well, there is a direction that the business takes in terms of achieving certain business objectives. The moment that there is an uncertainty, which could be from an outside environment or within the business or within the organization, it can result in either a upside or a downside for the business. There can be scenarios where you can the upside or the effect can result in even higher achievements, or it can result in those objectives being failed or not having managed to get the right aspect of outcomes for the business. The idea of an effective risk management is to manage this uncertainty in the most appropriate manner and ensuring that you achieve your business objectives in the right fashion, the way they are required to be achieved, and you make sure that we are able to achieve what we have targeted. And that's the entire premise of an risk management exercise. Collectively, all these activities of identifying risks, looking at them, assessing them, managing, and then monitoring them is what we call as enterprise risk management. Enterprise risk management is a collective activities that any organization performs to identify what kind of circumstances, what kind of events can have a negative or a positive effect on its business, what can be the risks of achieving its business objectives, assessing them from a probability perspective, from an impact perspective. And when we say impact, it can have impact on the financials of the business, it can have impact on people of that organization, it can even have an impact on general economy. We've seen scenarios where one business has resulted in, there have been risks that have played out for a business which have resulted in impact on not just that one organization, but in general that sector. So those kind of effects, the idea of an enterprise risk management exercise is to look at those risks, assess their impact, define a strategy to mitigate those risks to the maximum extent possible, bring them to an acceptable level, try and manage those risks to a maximum level, and then put up a monitoring process, because it might be a scenario that you can never be 100% risk-free. The idea of an enterprise risk management exercise is also to monitor risks on an ongoing basis, so that whenever there is a situation where the business is about to face a risk, we have certain set of early warning indicators, key risk indicators, which tell the organization to be ready and also prepare it to manage any kind of contingencies well. So, in a way, as we say, the idea is that we see the future and try and make sure that we are ready to face the future as it comes out and the organization faces it. The idea also is to reduce the negative impact and seize the positive opportunities as much as you can through calculated risk taking. When we said there are different kinds of risk for a business, this is how we would define the buckets of risk for any organization. You will see there are two aspects: rewarded risks and unrewarded risks. Unrewarded risks are generally risks which would result in a negative downturn for the business when they actually play out. It will definitely, when these kind of risks play out, the organization would face certain kinds of losses, non-compliances, fines, penalties, downturn for the business. The rewarded risks on the other side are where risk-taking is rewarded by the market and the external environment, and you expect a reward in return of that risk-taking exercise. And that is where we would call them as rewarded risks. These are the two broad categories in terms of the outcomes, but there are three broad categorizations or buckets of risks that you see on the screen right now. The first ones are imposed risks. These are risks which happen or occur because of an outside-in scenario. Organizations generally do not have much control over these risks from occurring. These are uncontrollable and at times even unavoidable. What we are living through right now was an imposed risk on the business, COVID crisis that resulted in an imposed scenario for a lot of businesses, even our personal lives. Self-inflicted risks, on the other hand, are scenarios where through mistakes, errors in judgments, not following the processes, we actually inflict certain risks on our business ourselves. This could be through gaps in any kind of compliances, SOPs not being followed, controls not being adhered to, and thus they result in day-to-day operational decisions going wrong, and thus the self-inflicted scenarios of risk coming onto business. Non-compliance of knowingly that there is a compliance requirement and not complying to it is a classic case of self-inflicted scenario. You will see that this is a controllability the scale of controllability, as we move from imposed to self-inflicted, the controllability of the risk scenario increases. Imposed risks are not in our hand, but self-inflicted risks, generally through better monitoring, better controls, better processes, can be reduced to the maximum extent possible. The third category is where we take risks to generate opportunities and grab opportunities. These are the calculated risks, which result in strategic and operational choices that a business makes to generate more value. Classic examples will be risks associated with new strategies, new products, new geographies that any business wants to enter. The idea is that you've looked at all factors of risk in your decision, and then you've taken that risk in a calculated manner to gain higher profits. We all look at the markets on a regular basis and invest in certain scenarios. Very classic example of calculated risk, which can turn into a self-inflicted risk if we don't do our study well and invest in something without knowing the in and out of that particular organization, and we may end up losing a lot of money. So you will also see, and if you look at any kind of risk scenario, the risks can a lot of times move from one bucket to the other, depending on how the situation has changed. A lot of time, an imposed risk scenario can be turned into an opportunity by taking effective risk management measures and turn it to a calculated risk scenario by business by exploiting that condition. And we will talk about these aspects further. The idea of an effective risk management exercise, an enterprise risk management as we call it, is to make sure that we reduce the imposed risks and self-inflicted risks to the maximum extent possible, control them as much as we can, and then increase our value through more calculated, informed risk-taking for business. As we were talking about, there is a certain inherent risk in any kind of a transaction, any kind of activity that any business does. Just by existence in itself, any organization will have certain inherent risks, which could be because of the geography that you operate in, the market that you are in, the competition that you deal with, the regulators that have certain control over your business and the sector that you operate in. The idea of putting in controls in any business process, in any business function, is to reduce these inherent risks to a residual scale, right? We all look at internal controls over financial reporting, operational controls, SOPs, and the various measures that are put in place by any organization. These are to bring down the inherent risk in our business, the health safety mechanisms. There are hundreds of things that we organizations do to reduce the inherent risk of its business operations. A further exercise of objective of risk management exercise is to bring this residual risk down to even further, put in controls, add further treatment plans, monitoring plans that can result in the residual risk going down to an acceptable level, which is within the appetite of the business. And these can be across the business functions and categories, which can result in our risk taking going down to an acceptable level, which is within the appetite of our business. On the other hand, the idea would be to reduce these self-inflicted risks to an utmost reduced value and calculated risks to a level which is within the risk-taking appetite of our business. So that is how these two concepts of inherent risk and the risk-taking within these three categories relates. And the idea of any effective, successful risk management exercise will be to make sure that the inherent risk levels go down to an acceptable level or a desired level, depending on what category of risk it is. An important element of risk management for any business is the governance over any kind of risk management activity. The idea is that you look at the governing bodies, which is the board of directors, the audit committee, the risk management committee of any business, and regulators in the country, which is our overlisted as well as private limited companies. The regulators in the country have put in the responsibility of effective risk management for any organization on the board of directors and its subcommittees of the committees to make sure that the management has effective practices over the business risks that it is managing, taking, or facing in any kind of a scenario. The idea is that you look at various aspects of business in terms of its core business operations as well as the support functions, which is where the risk taking actually happens. So if you'll see in this governance structure, the risk ownership really lies with the first line of defense in the business, which is your business functions, the support functions, and the owners of the business. Various processes are owned by them. They actually control, take, as well as face risks on a daily basis. So the control of managing as well as increasing the benefits out of any kind of risk management activity lies here. The idea is that there is adequate oversight of what the activities of the first line of defense in the business are, through effective oversight by the board and the leadership of the company. We've seen organizations which have effective risk management programs also have a central team which could be dedicated or coming out of the line of business, which is acting like a risk management secretariat or risk management office headed by a chief risk officer, who would look at various activities of the first line of defense and see what kind of risk management is being done across different business operations functions in the organization. This is then governed and have an oversight is there by the risk management committee of the board. There are certain classes of businesses, and we'll talk about these in the subsequent slides, who are mandated to have a risk management committee now. This is for the top 1,000 listed companies in the country. The risk management committee is a mandatory committee of the board, but nothing stops us from creating a committee which has adequate oversight over not just the business operations, but also the risk management activities of the business. This committee, along with the audit committee of the board, has been given the responsibility to have an oversight over the risk management and internal controls activity for the business and make sure that the management has adequate mechanisms to control risks that the business can have a negative impact on business, and wherever there are risks being taken by the business for future growth opportunities, that is where the management does effective risk management which is within its appetite. This is all then looked at by an internal audit function and then have an adequate oversight by the audit committee as well as the third line of defense of business, to make sure that what the first line as well as the second line in the CRO's office is doing in terms of risk mitigation, management, and wherever there is critical value at risk, it is being controlled in the right fashion. And if there is any investment being made to reduce risks, that investment sees light of the day and effectively manages or brings down the level of risk for the business. We were talking about the regulatory requirements. Largely, these are the two acts that require the risk management requirements for any business. Companies Act 2013, which actually mandates gives the responsibility of risk management, risk oversight to the board of directors of the company. Companies Act requires every organization, private as well as listed, to have adequate oversight on risks that threaten the existence of the business. And this responsibility has been given to the board of directors to make sure that management, as a part of its regular activities, is also doing effective risk management. Companies Act does not mandate a committee or a detailed committee formulation. However, SEBI, in its recent amendment, which has also revised and further emphasized on the requirements of risk management committee and its roles and responsibilities, mandates every top 1,000 listed companies from a market capitalization perspective to have a risk management committee of the board. There are certain mandatory roles, responsibilities, terms of reference, as well as compositions that have been defined for this risk management committee to meet at least twice in a year, and then disclosures are to be made in the annual report and the corporate governance report of the business to make sure that the shareholders as well as the general public is adequately informed about the risks in the business and how they are being managed by the management and how the oversight over those risk management activities is being done by the board. These responsibilities are, we're going to be talking about them further in detail, specifically from a SEBI LODR requirements. But The fact here is that regulators in the country are also emphasizing with a great impact on the requirements around risk management committee and effective risk management processes for businesses in India, and also mandating it through a compliance requirements to make sure that risks are being managed effectively by various organizations in the country. We spoke about briefly on the Companies Act requirements, but just to drill down a little bit deeper, the board report under Section 134 mandates the risk management policy for the organization and identification and oversight by the board over, as I said, risks that may threaten the existence of the company. Similarly, independent directors and audit committee, wherever applicable, have been given the responsibility to have adequate oversight and evaluate the risk management systems of the business and make sure that there is a robust governance structure and risk management system that has been put in place by the business, and have adequate oversight and make sure that they satisfy themselves over these requirements around risk management systems, processes for internal controls that the management is following. So these details have been, mandated by the Section 134, Section 177, and Schedule 4 of the Companies Act through the last amendment that came in. Effectively, we look at risk management or enterprise risk management as a 5-step process, which starts with identifying the risks that, as we said, threaten the organization's business objectives or can have an impact on the operations of a particular business. The idea is to look at all sorts of small, big, high, medium, low risks that the business can face, and then identify them, document them, and make sure that these are socialized with different risk owners, process owners in the organization, and they are aware of these risks in their respective processes. The next step is of conducting a risk assessment, as you see. Risk assessment is the exercise of evaluating a risk on various parameters. The first parameter is the impact of the risk, which is basically saying what will go wrong if the risk really happens. Will it impact our financials? Will it have an impact on business continuity? Will it have a people impact? Can it impact the social, environmental factors of the business? And can it have a regulatory impact on the business as well? So the idea is that you look at different impacts of the business. And the second aspect will be to look at the chances of its occurrence, which could be done through historical information or analysis of future trends through different kind of analysis techniques. So the idea is that you look at impact and likelihood or vulnerability of the business towards a particular risk domain, and then look at prioritizing which risks really matter. So the aspect of this entire exercise of risk assessment and risk prioritization is to identify risks that matter and risks that need adequate attention and an immediate attention. The next step is of creating risk response plans for these risks. These could be through mitigation mechanism, accepting a risk if you think nothing can be done about it, ignoring that kind of a business transaction, which because the risk is too high, transferring the risk or sharing the risk with a third party, and then thus basically defining a plan to bring down the risk or bring it within the appetite of the business as much as possible. And the last step, which is step number 5, is of risk review, monitoring, and reporting. Reporting will be done to the various governance bodies that we spoke about, the board of directors, the risk management committee, the audit committee of the board, while monitoring and reporting are important exercises, not just from a compliance aspects and not just because the board wants it, but the idea of regular monitoring is also to make sure that we know if a risk is going to hit us and we are prepared against it. While risk mitigation is an important aspect and trying to bring down the risk is an important aspect, an equally important element is of monitoring it also, because in case you are not able to bring it down to a zero, if it occurs, you should have certain early warning indicators which can help us in giving some kind of an alarm towards critical business risks, which we can then have contingency plans activated against. It's like a fire alarm that we have in our offices, just making sure that early warning indicators work and we know if something's going to go wrong, and we can reduce the damage to the extent possible through contingency planning, crisis management, and business continuity plan to be activated. That's the 5-step process that we follow, and this is also mandated by different frameworks like Kosovo, ERM, and ISO 31000. These are the leading frameworks around risk management that are available and followed globally by various large organizations. And they also align the 5-step process that you see on the screen right now towards different activities of business and making sure that you have a detailed risk profile available and then assessed and prioritized for your business. We spoke about the risk management and response strategies, as I was telling you, that there can be different strategies that you can adopt to manage or avoid a particular risk scenario. What you see on the screen are the 5 techniques that we talk about. Avoiding a risk, basically avoiding by not entering into a transaction, into a process, or not starting to continue in particular activity where we know there can be a risk. This is generally done in a scenario where the reward may not be that high, but the risk level is extremely high. Santosh spoke about, the braking system of a car. This is like knowing that a car doesn't have a brake, but still sitting in it. You would not do that. And similarly, avoiding a risk scenario comes in play here. The second aspect is of transferring a risk, right? You would contractually transfer some or the other impact of the risk to a third party. Classic example of this is taking an insurance where you try and pass on the financial impact of a particular risk to a third party, to an insurer who then takes ownership, and you together have an ownership towards the response of that risk. This can also be sharing instead of a transfer where some aspect of impact is shared between 2 parties. Third aspect is mitigating a risk. You mitigate it by either reducing the impact of that risk, the probable impact, or the chances of its occurrence. This can be done through effective controls, processes put in place, any kind of mitigation mechanisms that you decide to reduce the impact or the likelihood of occurrence of the risk. The fourth scenario is of accepting a risk and living with it. These will be scenarios where the risk could be a very less likelihood scenario, but the associated rewards are sometimes very, very high. So you accept and you learn to live with the risk, but you also make sure that you are ready to handle the consequences of that risk occurring if it occurs in future. In this kind of a scenario, the monitoring activity, when you have accepted a risk, you would monitor it much more frequently and make sure that the risk that you've accepted and you're living with, you are ready to bear the consequences just in case it occurs, because you will not be able to generally reduce. This is also generally done in a lot of scenarios where the risk is imposed by the outside environment of the business. And the last one is exploiting a risk scenario. This is where you would increase, you know that if this risk really happens and we've managed it well, it can result in an benefit for the business, and you try and exploit it for your benefit. This can be done through very, very effective monitoring mechanisms, making sure that your calculated efforts go very, very high. This would generally happen in case of calculated risk scenarios, and you would try and look at a risk event and exploit it for the benefit of the business. So we spoke about some basics of risk management concepts. We tried to do a quick refresh of what is risk, what is enterprise risk management, why is it important, what are the concepts of managing risks, what are the regulatory requirements. But, as Santosh started off and he spoke about the fact that risk is not really a dirty word. It is not really a negative connotation that we always attach with. The idea is that we rethink and reframe the role of risk management for today's businesses as well. So I'll hand over to Santosh to talk about the newer aspects and how risk management is growing, evolving in the current scenario, and what is going to be the future of risk. Right?
Santosh. Thanks, Deepti. That was very useful, I think, in terms of context setting. So, I'm sharing with all of you a report which was done by Harvard Business Review called How to Live with Risks. And there's a very important piece of statistics here. And I thought it would be important for us to spend a couple of minutes on this to what is the objective of risk management eventually? The objective of risk management, if you see at the highest level, is to protect shareholder interest, to protect company value, to protect market cap, those kind of things. And if you look at this report, in the past 10 years, the biggest erosions of market value have been caused by strategic risks. As you can see there, 86% of such events in the past decades were because of strategic risk. Only 9% operational and only 2% financial reporting risks. Yeah. But if we all step back and if we all look at, how we look at risks currently, what are our frameworks in place for, what are we addressing on a day-to-day basis regularly, and we are doing a very good job of that. I'm not saying that's not important. Are all the operational compliance and financial reporting. So that really begs the question that is the effort of risk management really focused on areas which can have the highest impact on business? So if you just focus on operational compliance and financial reporting, which is important, but if you only focus on those, will the objective of risk management be met? Will risk management be seen as effective? And the answer is a clear no, as statistics reveal. And in all these companies, you can also see the time that they spend, right? 86% of the market loss on account of strategic risk, but only 6% of the risk management time was being spent on strategic risk management, right? So clearly no focus, I would say, and it's a strong word, but there was clearly no focus on managing from risks, strategic risks. That when you've chosen strategy, what are the risks that come with it? And when you've chosen a strategy, you assume certain risks, right? And that's what Deepti was talking about earlier, that you now have to accept the risks which come with it. So how do you monitor, manage that? And if the risk is going above the risk appetite, and that's why we introduced some of those concepts earlier, that how do we reevaluate strategies? Is there a need to reevaluate strategies? And what is the role that risk management should play? So risk management is now a significantly important role and has a seat at the table as far as company leadership is concerned and as far as strategic thinking is concerned. So with that, we'll move to the next slide. And, Deloitte globally did a survey in 2019, and these are global CROs. It also had a cross-section of Indian chief risk officers and large corporates covered as well. And you can see there that, there is a unanimous agreement that, there is a need for risk management or corporate strategy to be identified with the risk profile that it brings to the business. CROs definitely believe that they are not doing enough on risk management. They should spend more time, not on risk management, but on strategic risk management. And they need to spend more time. Yeah. And that, if you see the last one, where 90% of the chief risk officers believed that this is going to become more and more critical in times to come, and that in the coming years, CROs will be expected to spend more time on strategy and strategic risk management. And why this is important is not just the framework, not just the methodologies, not just the tools and techniques that will be used, but very importantly, what are the skills that all of us on this call need to also start thinking of developing? What are the augmentations that we need to start doing to make sure that we understand this role better and we are able to play this role in a much more effective manner? So clearly, this is going to be the ask. I will not say the future. It is already now. As we keep saying, the future is now, right? So this we've already started seeing panning out. Deepti, we can move to the next slide, please. And, Institute of Risk Management is a global risk management, leading risk management organization, also carried out an assessment, after the pandemic. Okay, I think this is the wrong word. Pandemic is still there, so it cannot be after the pandemic, but after the pandemic started, right? So this is April. And very clearly, if you see, some of the startling statistics which came out, that almost 1/3 of the organizations, and hence chief risk officers, had not factored something like a pandemic coming and hitting their organization and virtually, literally crippling operations of a global nature, right? And even the 67% who had thought about it, right? and which is true because, when we work with large corporations, we've seen that several companies had identified something similar, may not be pandemic, but a disease outbreak, a virus outbreak, and we've had this in the past, but which were in smaller pockets. While they knew something like this would happen, they never put any plans for this. And why did they not put a plan to it? Because Dipti talked about it. Everybody thought of this as a low probability event. Yeah. So this is something that we need to keep an eye out for now, right? That, till now the focus was always, and when we were prioritizing, you saw that wagon wheel which Dipti presented, and there was a aspect on risk prioritization. When we looked at prioritizing risk, we looked at high probability, high impact, or medium probability, high impact, those kind of scenarios. We never looked at low probability, high impact, because we said, hey, this has never happened, highly unlikely to happen. Why does management need to spend its bandwidth, energy, effort, money on this? But the pandemic has taught us that don't lose sight of low probability, high impact events, because these could potentially be crisis events. And these typically give you very little time to respond. And hence, that's a big change which has happened. And I'm not sure if you guys have heard, I'm sure most of you would have read about, there is an author called Michelle Wucker. I would encourage you guys to read her book called The Grey Rhino, which is a different take on the Black Swan event. Black Swan event is an event which nobody saw coming, right? So really, the opposite of that is not opposite, is a similar allegory, similar visualization is the Grey Rhino. Grey Rhino indicates something that all of us were aware of, but we did nothing about it. Yeah, and the pandemic is one of those situations. So clearly, the risk management efforts are now moving from more compliance, check in the box, to being more value added, a strategic advisor to business leaders, and that is what the new normal is. So risk management, the expectation of risk management, and the skills that risk management professionals now need to bring to the table have changed significantly. Niti, we could move to the next slide. In the interest of time, I'll probably run through this a little faster and we can pick it up during question and answers. Dipti touched about the regulatory demand, so I'm not going to touch upon the regulatory requirements, which is changing some of these things, and we will talk about it in the next slide. What has also happened is that the leading frameworks which are deployed globally, which is Kosovo and ISO 31000, also now is talking about a significant shift in how risk management is approached. So strategy is becoming a key aspect. Emerging risks are becoming a key aspect. So it is no longer about only dealing with what you know or what you've seen in the past. It is also about how will you look at the future? How will you use various tool techniques, modeling, scenario planning to look at what could go wrong? I hate using that word, but it is almost like crystal ball gazing to figure out what could go wrong depending on the data that you have. What is also emerging, and the pandemic has taught us this than any other situation, is that risks are interconnected. Yeah, a risk in a particular function will translate into risk in another function. It is a given, right? Because an organization is interconnected. Organizations don't operate in silos. But risk management, unfortunately, when mitigation planning was done, was always looked at in a siloed manner. It had a departmental focus. And as a result, there were a lot of things which fell between the cracks. So now the approach is, how do you get an integrated risk management view where, like a well-tuned orchestra, your entire risk management efforts work in tandem, in a synchronized manner with multiple parties coming into play. And most important, I couldn't stress on this more, is that risk management cannot be once a quarter, once in 6 months, once a year exercise. It has to be ongoing because you have to pick signals if you have to look at emerging trends. And none of this can be done if you don't technology enable risk management, right? It cannot be something which is done on an Excel spreadsheet only based on discussions and questionnaires and interviews. We need to figure out how to use the ERPs the companies have, how to get key risk indicators, how to give real-time alerts based on the risk appetite that Deepti was talking about. So technology, as in everything else that we're seeing in our lives today, will play an extremely important role in risk management as well. If we have not started thinking about it, we must definitely give it a deeper thought to see how technology can help us. Deepti, you could move to the next slide, please. you could probably move the full clock. It's in the interest of time. So Deepti talked about this, and some of the changes that you're seeing in the Indian regulatory landscape on SEBI LODR, and this now applies to top 1,000 listed companies. And there is no reason why it should only be restricted to top 1,000 listed companies. Are we saying that private limited companies, there are several large ones, don't need to protect shareholder interests? Not so, right? So what is good for top 1,000 listed companies should be good for the other companies as well. Maybe not as complex, granular, but the premises and the philosophy still holds good. So now there is a clear focus on the risk management committee. They have said that risk management committee should have an independent director. There should be clear charter laid out, must meet twice in a year, and must disclose on what got discussed in the risk management committee, which has to now become a part of your LODR disclosures as well. Right. And very importantly, they've talked about business continuity planning. And believe me, this is not something which was thought of after pandemic. These discussions were happening even before the pandemic hit us. So, these are emerging trends really coming out to say, out of risk management, what do you want to achieve? You want to achieve, continuity in business in various form shapes, at various points. So that's become a critical aspect. Deepti, if you can move to the next slide. And very importantly, a few other things that has been called out other than continuity plan, and which I think all of us are today aware of. We spoke about strategy already, right? But other than that is to bring a sectoral focus, to say that, don't do generic risk management, which probably is good for financial controls, etc. But when you're looking at operational controls and real risk, please get a sector focus. Risks in financial sector will be very different from consumer sector, will be very different from pharma sector. So how do you make sure that you bring the sector focus on what can go wrong in that sector? And something which all of us know today, all boards listed or otherwise are speaking about is climate change and sustainability. So, and the LODR has now called this out very, very critically, because this is without a doubt one very, very important risk that the world faces today. Right? Environment and social. So diversity and inclusion, climate, sustainability, if these are conversations that your companies or clients are not doing, you must start nudging them in that direction, because all of us will be impacted. And as good corporate citizens, it is our duty. We are duty bound to address this so that we leave a better world for our next generation. Deepti, we can move to the next slide, please. So move forward. So with all this, as regulation is changing, the need for strategy to become center place, right? For need for us to look at climate sustainability, for us to become sector focused. And I'm sure all of you have experienced this in the past 6 to 9 months, at least I have, that earlier conversations on risk management were with the CFO, with the CRO, and wherever there was a risk management committee, with the risk management committees. But what I have experienced in the last 6 months, in that every CXO meeting, every CEO meeting that I go to, at least 20 to 30% of the time is now on risks, because pandemic hit everybody hard and most people were not prepared. So, so that is something which most CEOs are talking about. And most boards today have wanted to take a relook at risk management, to say, listen, what we were doing may have helped us in the past, but where we want to go, it may no longer be sufficient. So you will now see more leadership attention and more discussion with the larger leadership of the organization, and not just restricted to CRO. And hence, I go back to the point that our ammunition today as professionals need to be wider. We can't just have a few arrows in our quiver, right? We need to expand what we can do from a strategic risk management. Technology has become key. What kind of technologies will you do to detect risks, sense risks, do scenario modeling, right? Risk-based decision making, return on risks. All of those aspects will need to come in. So it will become more statistical, mathematical oriented. So people who work in financial services will know about some of these modeling methods which are used. All of this is becoming applicable to risk management. And I say this because I'm cognizant that we are a forward-looking profession, and we must start thinking of what are the things that we need to start imbibing so that risk management and controls become that much tighter. Yeah, and it is not adequate just to put in these processes, right? As I said, vigilance and resilience will become an extremely important part. Vigilance, so that you keep monitoring it, you keep refreshing your models based on inputs that keep coming, and that is what will create resilience in the system. Resilience will only come from the organizing, practicing its processes. We all wish that the risks don't materialize and hence nothing goes wrong. But if the risk were to materialize, do we know how the organization will respond? So resilience can happen only by practice. And Deepti talked about, I think earlier on environment, safety drills, etc. So like for fire and safety, we have drills that we do. For each of these high impact events, we will need to put in crisis management playbooks. And Deepti will talk about it, which is where, the company becomes resilient because they've practiced such events happening and they know how to respond. And very, very critically, risk management today cannot be standalone. It needs to get integrated with business continuity and crisis management planning. Deepti, I will hand it over to you. We are already 7. Deepti, so maybe you should just take 5 more minutes if you can. I know there is a lot to cover, so that we have some question and answer and interactions as well. You're on mute, Deepti.
Thanks, Santosh. I'll try and quickly cover the remaining few slides that we have. There are expectations. Santosh said that, across our CXO conversations, across businesses, CXOs are waking up to the conversations around risk management. It is becoming more and more, pertinent in all these conversations that we have, that what is the risk here, and that's becoming an important topic. But what are the expectations that we are seeing boards and leaders have from risk management activities and risk management functions? It is not just to, give us a laundry list of risks, but the idea is that you spread that awareness of risk across the business. It is not a quarterly exercise that needs to be done in an Excel spreadsheet, but it really needs to spread across the business for having a more risk-enabled culture, risk-aware culture, which results in having knowledge of different risks which we face from a business as usual scenario, from scenarios of driving a strategic decision successfully and making sure that we have enhanced value creation out of those decisions that we take, and also to exploit opportunities as much as possible. So decision making, you'll see some keywords on the screen in terms of what kind of performance enabler risk management can become. It is not just a value protection game anymore. It is not just about looking at financial operational risks and then try and protect that value, but also to create value in terms of ensuring that the business takes effective risk decisions and increases its value and turns out to be more resilient as an organization by integrating risk management, not just with our regular business operations, but also effectively look at crisis scenarios and build mechanisms that can help us fight a continuity or a crisis mechanism much, much, much better, and thus give us a more competitive advantage over the business that we are running. Moving on, Santosh spoke about these, and thus I'm going to quickly run through them. One of the requirements that has come out from the LODR aspect, and they have clearly called out some of these domains of risk that you see on the screen, but any business can face these different kinds of buckets or categories of risk that we've put up on the screen. It could be internal in nature, which is where a risk is originating from our normal operations from within the business, and it could be an external risk which the company may face from its external ecosystem that it operates in, which could be the regulators, competitors, vendors, customers in a lot of scenarios, the geographies that you operate in. So some of these categories can become internal as external, or sometimes both kind of risks as well. So financial risk, very clearly risks that impact the financial plans and activities for the business. These can be future financial scenarios or the existing financial situation for a business as well. Operational risks, which are from our regular operational activities, can result in any kind of operational issues, failures in the business. Sectoral risks, Santosh touched upon, sectoral and sustainability. These two have been clearly called out by the LODR amendment that has come recently. And they want businesses to focus on risks emanating from the sector of business that you operate in, which could be, how does the external ecosystem or the sector that you are a part of impacts you as a business. Sustainability is pertaining to risks around sustaining the operations in a people, profit, and planet scenario. It's not just about the business, but it's also about the planet, the social environment that you are operating in, as well as the global, climate change scenarios that you operate in, and those need adequate attention from a risk management perspective. Cyber and information, aspects of cybersecurity, cyber attacks, they have been on the rise. You would have read in the papers in terms of the risks that organizations are facing from a data leak perspective. These are not just impacts on business, but we all as consumers also face these when any of the organizations there, we receive messages. Recently, I got one from a social media platform saying, please change your passwords because there's been a, data leakage that they've faced. So again, an important aspect that has risen up. Reputational, anything that impacts any of these risks can also become reputational risks overall, but it's basically preserving the brand and reputation for the business and how it can impact. Regulatory will be from a regulatory compliance scenarios that the business faces and lives in. Very important aspect is extended enterprise. Extended enterprise for a business will be the key third parties, fourth parties, contractors, strategic partners that you are working with. No organization today exists in isolation. COVID has really, risen questions over effective management of extended enterprise for any business. Businesses really struggled at times just to make sure that their vendors were operating well when the lockdowns happened and they couldn't sustain financially or operationally. So a critical aspect of risk is also the extended enterprise in which you operate and making sure that that is catered to well.
Yeah, and Dipti, just to add there, I think all of us must be reading about the latest chip shortage that the automobile industry is facing, right? It's a classic example of the extended enterprise risk. Everybody saw this, but nobody thought it will become so critical for operations that, plants have now pulled down production.
Yeah.
Just wanted to mention that.
Yeah, and it's also an example of technological, the risk that you operate in. So yeah, both extended enterprise as well as technology risk that organizations are facing. Some of them saw it coming and they've kind of done some quick fixes to try and do something else around the scenario or change their chip designs. Strategic risks are around risks of and risk to strategy that you take as a business and how effectively you can manage, monitor it, making sure that the strategy sees the light of the day. These have been now mandated by, some of these have now been also mandated by the LODR. Now, I'm going to quickly touch upon some of the leading practices that we have seen more mature organizations who have a very effective risk management program, at least in the India as well as global scenarios that we've seen. A lot of them also come from, not just the banking sector, but also technology, e-commerce. Some of the large manufacturing organizations we've seen are moving on the continuum of risk management and making sure that they are building from a strategy and governance, technology, operating model, as well as people and culture aspects, effective risk management exercises. And these are some of the leading practices of, we spoke about risk governance. We've seen organizations who have matured over time have a very effective layers of governance over different aspects of risk. They just don't leave everything to a risk management committee, but they have more effective councils, specialized people looking at different facets of risk for the business and making sure that that governance runs very regularly. As Santosh was saying, don't wait for the quarter to end and risk management committee to see, but run it on an ongoing basis and make sure that you are aware of the risks that you're taking in as a business. The second is of having a more robust risk appetite framework and making sure that your business decisions are valued and measured against those appetite. And the last one is aggregation. Don't look at risks in isolation, but try and look at aggregated them, looking them at a more portfolio level view of the business and can 2 or 3 of them together have a more added impact on the business scenario. COVID gave us multiple examples where risks got aggregated and created a more snowball effect for businesses where you couldn't operate, your vendors couldn't operate, and a lot of it aggregated and resulted in a big crisis for businesses. The next aspect is of technology. We've seen leading organizations look at various technology platforms, not just to manage risk operations from a GRC perspective, but also look at technologies like risk sensing, continuous controls monitoring. I believe there is a session around that, after this, and tools like scenario modeling, stress testing, predictive analysis to look at risks from a future state perspective, try and predict chances of those occurring, and then look at sophisticated technologies like artificial intelligence, machine learning to help augment what the human brain can and try and look at the future state for those risk scenarios. The third is, having a more defined operating model. We've seen organizations who are doing well on risk management create risk champions within the business. They just don't look at one chief risk officer, but create risk officers, risk champions within the business and attach their KPIs to effective risk management. It's not just that you do it because the law mandates you. You do effective risk management because it also helps you grow your business better, manage your operations better, and thus it becomes a critical KPI for the business. And the last one is to look at culture across the organization, making sure that organization-wide understanding of risk management and risk exists. And there are certain niche skill sets that organizations are now investing in to look at the technology aspects that we spoke about and look at what matters for that particular business in terms of critical skills on risk management and acquire those from a people and culture aspect as well. Yeah, we've spoken about some of these technologies, so I'm not going to spend too much time on this slide, but we've seen trend analysis, assumptions testing, risk sensing. These are all critical tools and techniques that organizations can now use to look at effective management, monitoring, and maybe in some cases prediction of risks in a more smarter way. The next one is more around managing high impact events. We spoke about crisis management and how you can effectively link risk management, not just as a mitigation strategy, but also look at what if it really happens, how will I manage it? So an important aspect of looking at risks is to look at these high impact, maybe low probability scenarios, which if they really happen can become a very big crisis for the business. So risks, you identify risks and as you see the process, you identify certain risks. When they happen, they can become issues. You manage them, but if you're not able to manage them and they really become bigger, there can be a crisis that the business can be hit with. And that is when you look at recovering and responding to that crisis scenario. And once you emerge out of that crisis, it becomes a new normal or the business scenarios would have changed. This is something that we've all lived through in the past year and a half, where a crisis happened and we've all responded to it, recovered from it, and we are learning newer ways to live with it now. An idea of an effective risk management exercise is to also identify certain crises like this, look at your risk portfolio and see which can really become a crisis, and identify mechanisms in form of playbooks, in form of crisis management plans, in form of preparing for the worst case, to making sure that if you're not able to prevent a scenario from happening, and if it really is an imposed case in the business, you look at then responding and recovering from it, and then emerging stronger and learning to live with it. So effective risk management would also link these two activities and make sure that you are able to have a good command over high impact events and you are in control of them when they actually happen. Santosh, you want to summarize and then we can go to questions? Yeah.
No, thanks, Deepti. I think that was very, very useful. I know you were stretched for time, but I think you covered the high notes there on what we need to do. Just wanted to leave this on the slide, on the presentation. Some of the things that we are seeing emerging trends really. Very importantly, when we say future of risk, it is not tomorrow, it is today. I think things have started changing. And hence we all professionals who are looking at managing risks and managing controls need to look at these emerging trends, see what we need to do to equip ourselves and be of real value to our clients. So with that, we'll open it up if there are any questions, clarifications that we can address.
Shubham and Neha, if there are any questions, happy to take them.
So there is one question from Saurabh Badwa. He asked how to assess strategic risk. Over to you, Deepti.
So, looking at strategic risks, there are various mechanisms that, an organization can look at in terms of assessing strategic risk. And it largely happens when you're building your strategies for the business. The idea is that you look at two types of risks in that category. First is risks of strategy. Basically, is that strategy in itself correct? Can that strategy bring more risks to the business in future? And the second is risks to strategy. That would mean basically risks that can result in effective implementation of a strategic scenario that the business is planning to implement. So when you do strategic risk assessments and identification of strategic risks, the idea is that the risk manager, the risk officer's team, sits with the strategy function and works hand in hand in terms of identifying what can be the risk of and the risks to strategy, making sure that we have our assumptions tested. There are certain assumptions that you would build in various strategic plans that you build for your business. So idea is that you look at those assumptions, challenge them, and be ready to answer any kind of scenarios which can happen in terms of various sensitivities that we built in from a future state planning perspective. So those are the aspects that you should look at when you're doing your strategy building exercise. Santosh, in case you want to add to it.
No, I think you covered it all. I think the only other aspect that I'd like to say is that, the strategy risk identification would require the risk manager himself or herself to understand the strategy very well.
Absolutely.
And as Deepti said, understand the assumptions. And these are all typically the best way to do it is to do it through workshops. You get all the business leaders, and that is where you challenge assumptions to identify risk to strategy and risk of strategy.
Also, there is one question from Ashish Gupta. He is asking, is enterprise-wide risk management and enterprise risk management is one and the same thing? Yes. Over to you, Deepti.
Yeah, it is the same thing. These are just different names for calling out the framework, but yes, it is the same thing.
Yeah, absolutely. I think the only difference today that we are seeing is that risk management itself is getting categorized. So, and first, as Deepti said, EWRM, ERM are the same. But within risk management today, we are seeing separate focus coming on strategic risk and separate focus coming on operational risk. And strategic risk is typically a top-down exercise that you do.
So I believe these were the only questions that, okay. So there is one question from Sridhar Krishnamurthy. He's asking, as an auditor, what are the legal implications if the risk identified by auditors is not reported in report, or should it be reported?
Sorry, Shubham, please repeat the question again. Who is that from?
From Sridhar.
Okay.
He's asking, as an auditor, what are the legal implications if the risk identified by the auditor is not reported in report, or should it be reported? Like he wanted to ask if he has not reported the risk in his report, auditor's report, what will be the consequences or the legal implications on it?
Yeah. So I'm just trying to address it both from a external auditor and internal auditor perspective. So first, let me address it from an internal auditor's perspective. See, internal audit is the third line of defense, right? So internal audit is not supposed to either set the risk appetite or to identify the risk or to run the risk management process. It is really between the first line and the second line. The internal audit is responsible to make sure that the risk identified are managed, mitigated well. The controls are adequate to manage and mitigate. But, we all know that if there is an obvious risk, and if the management first line and second line is not identified, it does not preclude internal auditor's responsibility from having identified that. So from a professional standard perspective, yes, the internal audit that way, if he or she has not identified a key risk, there will be responsibility cast upon them. That's one. Now, as far as the reporting on risks go, I think the internal auditor in their report will, of course, we all know what gets reported, how it is reported. But from management disclosure perspective, internal audit has got no role to play as far as reporting of risks are concerned. Sridhar, I hope that answered your question. If there's anything follow-up, more than happy to address it.
There is one question from Ashish Gupta. Another question, what are the other frameworks for ERM other than Kosovo and ISO 31000?
Several other. Deepti, why don't you go ahead?
There are several other frameworks available. There is a Turnbull framework, there is a COCO framework, the way there is Kosovo. So there are multiple frameworks available. And most of them talk about risk categorization process in very similar formats with certain differences in the technology. You'll also see risk management frameworks from a health safety environment side. That is where it actually started, where FMEA and activities of fault identification and risk identification really started. Banks have a lot of different frameworks which are governed by the regulators. So different industries look at risk management in different aspects. From more manufacturing, organization side, we've seen ISO being one of the most widely adopted one. From more, European countries, Americas, we've seen Kosovo being the favorite there. But most of these frameworks talk about risk management in the same summary of the 5-step process that we spoke about. And now most of them have also been updated to align with strategy a lot. But there are multiple frameworks available in the market that you can look at depending upon the sector that you are in. Shubham, any other questions?
So I think there is one last question from Subramani.
Okay.
He's asking, like internal audit, is CRO and risk management department expected to maintain independence of opinion/reporting rather than being part of process or operational owner?
So let me address that, Deepti, and you can add it. No, obvious, of course. So risk management typically is a second line function, right? So in that perspective, Subramani, they are supposed to have independence from the first line. As Deepti said, what the risk management organization does is put together a framework for the company, help facilitate the identification of risk, help facilitate identification of the risk appetite and the methods of measuring it, right? But actually, the risk ownership sits with the first line still, right? So it is who are supposed to play a larger role in identification and management of risk. So executive responsibility still is with the first line, and second line is facilitating the framework, management and monitoring. And hence they need to keep independence, and they need to have their independent views on the criticality of risk. That is where they come in. So once the business identifies, risk management should be able to challenge that view to say, are there more risks or are there risks, criticality identified correctly? And then the third line comes and actually validates internal audit on whether the mitigation plans are operating effectively. So I know we have run out of time. So thank you all. It was a real pleasure speaking to all of you. If there is anything that we can provide more clarifications or help you with, I think our details are there with the folks who organized this, and you can reach out to us. But thank you very much, Amit, Neha, and Aarti, of course, for helping us with this.
Thank you so much. you, Bhavin. Shubham, over to you, Shubham, Aarti, and Neha.
Thank you, Santosh and Deepti, for joining this session. And it's really a very good session for each of us to, understand the risk management as well as future of risk and how everything is, integrated in the current environment. So really thank you for joining this session. I would, Ram Prasad has joined and he has started it. Let me welcome CMA Ram Prakash to this session, and let me give some background of Ram Prasad ji. He has started in Messrs. Ashoka Limited in internal audit profile in the year 1997. In 2000, he has moved to L'Oreal, India, and in charge of the branch finance as the in charge. He has also joined Colgate in 2005 and has worked in the various profile, budget and planning, sales, finance, treasury, greenfield projects in Sri City. Currently, he is heading the internal audit function. So over to you, Ram Prasad. Thank you.
Thank you, Shubham. Hi, everyone. I'm Ram Prasad. You have had a brief introduction about me. I'm actually working for Colgate Palmolive currently and heading the audit function. So this particular topic on internal control and risk management was given to me. I'm more going to share to you from a business perspective. Like, we are part of the audit team, and we'll be mentioning to you, and my presentation will be on how we are doing this from the business point of view, like how risk is perceived and how do we manage it internally. So I'll be just sharing my screen. So my screen is visible, right?
Yes, your screen is visible.
So in the last 1.5 hours, you must have heard to Deepti and Santosh speak about risk management and internal control, more from a technical side. So this is more from a business side. So I'm happy to actually share with you what are the best practices which business generally follows as an internal audit. What do we do? So before I start my presentation on this, let me quote to you a verse from a famous book called Tirukkural, which was written some 2000 years by the saint poet Tiruvallur, in which he is mentioning about the role of a king in terms of wealth management. I would, in simple words, interpret it for the audience in this manner. What he is mentioning is a finance professional, I've just interpreted this, for on behalf of a king, plans and acquires wealth. After acquiring wealth, his responsibility is in terms of safeguarding it, investing it wisely, and spending it very prudently for the prosperity of the company. In our parlance, for a auditor, you can say for the growth of the client's wealth. So these are the key aspects which Tiruvallur mentioned in this particular verse. So I have highlighted the word safeguarding. So here, the topic which we are in is in terms of the internal control and how we have to mitigate the risk. So in the future slides, we will see how we can, as an audit function, how do we safeguard the wealth of a company. So in presentation which I'm going to give you today, we'll be touching on what is the business environment currently we are in, what are the risks perceived by top company executives, what are the top risks which they are identifying it, what is the role of internal audit, and what can be done in terms of mitigating this particular one is what we'll be taking. Where are we now? The business environment in which we are in is very dynamic. It's changing every day. Technology changes. For instance, we used to very recently used to go to a cinema hall to watch a movie. Now it is all OTT platforms due to several reasons. A Canon company, manufacturer of cameras, had earlier identified Nikon as their competitor. Now we have a mobile phone which takes better picture than that of professional cameras. And we are now interacting on an app called Zoom, which has actually replaced. It's a challenge to the airline industry. Few years back, I would still, when I was in sales finance, we used to meet every quarter in the head office. People used to travel to the head office. We used to meet for about a day or two discussing about the branch's performance. And that is all gone. It's now online. Imagine earlier days when we used to we have to buy any product. We used to have an in-store kind of a business where we used to go into a shop, take the benefit of the executive who's there, ask him for what is the best thing which is being sold, and based on his recommendation, we used to buy. Now that is all changed. We go into YouTube, we have so many reviewers. That reviewers not only gives you the specification of the product, in addition, they also give you a suggestion as to which one is the best suited for you. And based on that particular YouTube review, we go into an online portal and buy the product which we require. So business is changing externally and also internally. With pandemic situations, remote working has also started. We have stopped seeing people face to face. We all work from mostly organizations which are technologically advanced, work from home. So things are changing. If I have to just ask, is it not changing earlier? Was it not happening earlier? No. Change is permanent. It used to happen. But now, the rapid speed in which it is happening is what is the important thing which we have to note in the current business environment. The rate of obsolescence has gone up. The last year, when compared to the globe, India is fast. The obsolescence rate is much higher. So this is what is the environment which we are in. Given that, recently there was a survey which was conducted with top corporate executives on what do they perceive as the risk for the business, for their businesses. One major thing which came up is on the security, cyber security. You will be hearing about the cyber attacks which have been happening all over the world. Cyber attacks is nothing but malicious software which gets into your database system, and with the power of their hacking, they take your entire database and the computer system hostage, and they threaten to share important company data online, and they demand ransom. So recently, JBS meat supplier, Colonial Pipelines, you must have heard about. They have a thing in Taiwanish computer company of Acer, which they had a demand of $50 million for releasing that particular ransom. And in ICAI Motors in the US, if you think it's only global, even in India, recently Air India had seen ransom attacks. We had instances in the food manufacturer Haldiram's. You must have also heard about the Pune Smart City project of Pimpri Chinchwad municipality. Everywhere this is happening, and money is being demanded by these people. And in terms of data, we collect a lot of information from our consumers, customers, and also employee. We possess certain personal information about their identity, email, and certain specific sensitive information like debit card, credit card information. So the protection of it is very, very important. If someone from outside can have a contact, or the people who have control of the data shares it by mistake, the consequences which a company will face is enormous. Business continuity is another area. Like for instance, if you are in a particular industrial area and that area is identified as red zone, people cannot travel, your entire goal for that particular year, every company runs on a business goal. It depends on certain amount of volume of production. If it is hit, your goal is not achieved. Imagine if your server where the key data is saved is down, then how do you manage? How do you manage the entirety of the controls? So this is one area which has been identified as a risk. What we are till now mentioning is all the internal risk. What if my third party who's dealing with us, the third party with whom we are doing business is hacked? The system, they are also susceptible to hacking. And the recent time, you must have heard about the Mercedes-Benz instance where the buyer details got shared in the net and it got spread. And then imagine a situation where your strategies and your the company's schedules are known to your competitor through your third party, through your vendor. It's again a risk. So how do we manage? This particular one was also perceived as one of the risks. Every organization, as I earlier mentioned, we run on basis of a growth. If we have, a target of a 5%, 10%, depending on the industry where you are in, there is a sales target which everyone work on. When there is an impact when it is on economy, like how would I mention is, imagine the current situation of a chip demand which is going on in the market. It is actually impacting the production and sale of commercial vehicles, laptops, computers, and not to mention even in the recent times, you must have heard about the container shortage. Due to container shortage, goods are stuck. The input materials which have to come from other countries are stuck. Goods are not being exported. These economic conditions also can impact one's business. Regulatory changes, not to mention more, for instance, a country from which your materials are being sourced, if for some reason the government identifies that as an enemy country and sanctions or brings in some regulations to prevent it or increases customs duty, it has an impact on our input cost, which again impacts our profit. So these are the top risks which have been identified or perceived by some of the corporate executives in their survey. So let us see the role of internal audit. Traditionally, the role of internal auditors, like I have earlier mentioned in the first slide, is on protecting the company asset, and periodically reviewing the internal control effectiveness and the adequacy. Always in terms of detecting fraud, which can come from any direction, internal, external, and not to mention about your compliance to accounting standards, and more importantly, being internal auditors, you need to also see the company's financial policies are being adhered to. Another important aspect which also as an internal auditor is expected of them is on the process improvements. If something can be done in a very swift and a better manner, the audit team is expected to simplify the processes and also to try to identify if there are any cost saving. So cost save is actually profit generated. So these are your traditional role of an internal auditor. However, we have seen earlier some of the risks which are associated with business. So before we get into this, we have now got a problem statement, which is what? Business is changing rapidly, and there are certain newer risks which are identified, and we have a traditional approach in terms of audit. But what we can do to mitigate it and remediate it is what we am trying to share with you. This is more from sharing knowledge from the business side. Hence, what we do, I'm just sharing with the entire members here. So let's start with IT risk. Top 2 or 3 points were relevant to the IT related, data related risk which were being faced. Let's see about IT risk and how we can manage it. So when it comes to IT risk, the system which most of the companies follow is of this 4 main thing, which is look outward, look inward, look backward, and interface. What is look outward is more, I will just define in 4 words, which is to protect, shield, defend, and prevent. Look inward is monitor, detect, and hunt. Look backward is respond, recover. And what will be interface is more to do with how do we communicate, manage, and govern it. I'll explain it further in a following slide. So to start with, I mentioned to you about look outward. So this is from the external threat. We have to first of all identify what needs to be protected and how do we protect it. So I'm not getting detailed into the strategy and the tools which we follow, but it's there for you to see. We have something on how to identify asset management, and to protect, we have identity management, awareness of data security. All these things are your thing to. The major 2 points which we need to identify or to note here is identify and protect will be the thing which we have to follow for look outward. The next thing which I had mentioned to you was look inward. It is constant monitoring of your systems that we have is to detect and find whether is there any processes which needs to be controlled, which needs to be prevented with certain strategies like event detection process, security controls monitoring. All that is the tool which we use to detect and to respond. For instance, if something needs to be responded, something needs to be fixed, we need to have a response planning, analysis, and mitigation improvement. This is what is on the respond part. To explain the third point which I had mentioned was look backward. It's like, for instance, with all these controls, if still our systems are impacted and we are affected, we must have been going in a steady path and there is a fall by an attack, then we need to get back to the previous best. So that is look backward. So get back or recover the system back to whatever stage it was in is what is look backward. And I had earlier mentioned about interface, which will be the role of a IT team, IT internal control team will be to constantly govern and manage this kind of IT threats and then comply to certain norms and also like data theft and other things, and to educate people about phishing, what are things which comes out, maybe a job offer kind of a mail which comes in. That particular thing is the interface. These are the 4 segment in which IT related risks are generally managed by organizations. So first point mitigates the IT related risk, how it is being managed. Now comes our analysis of trial balances, the financial reviews. So what does this throw? How do we do in this particular one? So we have something on a trend analysis. So just to quote, last year when we were reviewing our books, we had seen a high amount of demurrages being charged. The utility charges were soaring. So when you get into the details, when you periodically review financials, you get to identify certain things which comes out from the finance, the ledgers speaks to you, gives you information. When you get into, we understood the problems faced by the imports team, in the logistics team in terms of releasing of goods from the customs port. So we had addressed it by planning some alternatives. So a trend analysis at that location helped in terms of reducing the cost. Data's aging, creditors aging. When you find higher recoverables or data's being high, it's an indication that something is not going well. Our follow-up or something isn't happening. So that is an indication which you have to pick for having your conversation with your customers in terms of follow-up and reconciliation and getting our money back. Again, on advances, deposits, it's again we pay as when we do your business, you give your money as advance to recover. If it's long pending advances are not recovered, a review of a ledger can identify these things and we can do it. Inventory holding. So there's another tool which we do in terms of the inventory days. If there is when you compare previous quarters, if you see a change in the inventory holding pattern, that is an identification or it's an opportunity for us to identify that inventory is not being managed well. It could be someone who is procuring is not adhering to the schedule. So a review of it can release a lot of unwanted blockage of capital, working capital in terms of inventory. So the other tool which we want to mention is on the variance analysis. A bigger organization will have multiple vendors in them, and each will have a different pricing. There will be a mix in terms of procurement. And when in the actual mix in which the standard price had been earlier fixed is not being followed, it will result in a fluctuation in terms of a price. So this review throws out that something is not going as per plan. So a review of this can again result in the variance being fixed, which actually is resulting in profit. And functional reviews, we always have a schedule. Every organization reports into the board will have a schedule, a fixed schedule in terms of reviewing various branches, sales units, manufacturing plants, department, and specific activities we review on a periodical basis. And any gaps identified will be reported with the auditee, just the particular team, and also reported to the management as well as the board of directors. This gets addressed and our suggestive corrections are also mentioned. Another tool is again on your ratio analysis. Ideal ratio, if it is not followed, we can review it. Reasonableness analysis, another good tool to have, where the validity of information that is provided to an accountant can be verified. For a few examples are like when you compare the warehouse space with the inventory holding as a point and refer it to the previous quarter, we can find there's a trend, there's an analysis which you can identify. Similarly, like for instance, if you compare the receivables as against a comparison with sales, if the receivables are high, low, when you compare it, you can identify if something is not going in the right direction. So these are some of the tools which your trial balances throw when you periodically review them. The third and the fourth one, which I would mention, is purely from Sarbanes-Oxley being a US organization. The internal control, we have a framework which is defined from Sarbanes-Oxley 1, which is on design of testing of design and also testing of internal controls. It's an internal annual process. I would mention to you what is actually going into this particular one. It's a very effective tool. The whole organizational cycles, different cycles are clubbed in this 12 heads. To name a few are revenue, expenditure, fixed assets, inventory, treasury, like that. So all these are various cycles which has a flow of process, flow of documents. So we as an organization some time back had put forth, understood, identified what must be the proper flow of documents, proper flow of the processes, and we have documented it. Every year, we perform a design testing to ensure that whatever the design in which it was supposed to be, whether it is being followed, that is the process of design testing. So I'm just given a small extract of it. So we have a flow chart of the flow of documents, the flow of control, how it has to be, and this gets reviewed. This can happen periodically once in a year, or if there is any change in the processes due to some merger, acquisition, or anything, then this particular process will be again reviewed and we can make the corrections to the design. This is on the design testing, which happens once in a year. Next is importantly on the control. The 12 blocks of controls which I had mentioned has further, we have classified them into, we have, organization tests nearly 90 to 100, the controls are there, which is nothing but clubbing all these particular checkpoints into different heads, processes, sub-processes. Like for instance, I've given you a sample here. In treasury, when when you have a new bank account which has been opened. So in this, what we need to check, whether we have a code resolution, whether the resignation letter had been given, whether this particular one list of authorized signatories have been properly informed. This is on in terms of reviewing whether this has happened is what, and when is the occurrence, whether this control is key or non-key. So all those things are, this is kind of a direction which is given for us to check. So we source for the document, we check this, and we see the adequacy of it. Later part, another thing is on bank review, whether periodically bank balances, signatories are being reviewed, the limits are, if there is a person who has resigned, whether we have a board resolution to make those changes, whether intimated a bit. These are certain things which are part of the internal control, which we keep reviewing it once in every half a year. So in a year, six months, we cover it. Another example is on revenue. I'm just given it. You will all be aware of the quarterly cutoff. So every after the closure, few points which we generally do is revenue is recognized on the basis of your customer accepting your goods. So whether the management reviews that there's a route list, there's a route code based on the expected time the goods are being received at the location, you have a automatic system in system driven thing based in the SAP system. However, the proof of delivery, the hard copy in which the customer has received and put a stamp and the date of receiving, whether it's getting reviewed for accuracy of the data. If there is any very significant differences, is the concerned person, like in this case, the corporate controllership group, whether they are being informed, whether this particular kind of a review is happening on a periodical basis, like once within the 10 days of closure of a quarter, and whether this has been completed. These are various distinct guidances which are given to the audit team by the global risk and compliance team. And we perform this with the business. And based on the information which we provide, which we have taken it, we identify whether there is a control lapse, is there any reason for any kind of remediation in that particular one. All that is captured and we are doing it. So just to give you a summary of the entire activity, around the month of May, the GRC team, the global risk and compliance team, updates the list of tests which has to be performed for the particular year. We do the design testing around the month of June. Later June, July is the first phase of testing for test of controls for all the 12 buckets of areas cycles which I mentioned. The results are shared. If there is any gaps found, remediation plans are derived. In the next cycle, after 6 months, around the month of November, when we again start for the second round of testing, a roll forward, second level of testing plus the remediation, how it has come in, that is being done. The results are again reviewed. And we have the year-end closure, which happens in the month of January. This is 1 year cycle. This continues year after year after year. So this is a complete, calendar of test of design and test of control, in which most of the cycles which are any organization will have gets covered. So this is on the design testing and the control testing part. Most of the points which I have mentioned is from an internal auditor perspective. More than an internal, this is only from audit perspective, which is being performed. But more than this, empowering the process owner is another important area, because, for instance, I have an eye from internal audit, 2 eyes, but when you have multiple eyes, everywhere you have people to review it, the gaps can be very easily identified and process much things can get into line, I'll just explain you how we do the self-assessments using the process owner. I'm just putting forth a couple of areas. For instance, sales office. So what are the relevant questions to be asked by an auditor at the sales office location? We form a questionnaire, and this questionnaire is answered by the process owner. For instance, VFM is the branch finance manager. On a quarterly basis, the person has to do the self-assessment. For instance, in a sales branch, what happens? Expenditures, whether the expenses are GR has been taken, post goods has been received. There's a inventory which variances has been posted by the warehouse. So whether the logistics team and the branch finance team reviews each and every variances, checks for any major variances, reasons are identified, yes or no. It's a very simple question. So when they mention yes, this has been review has been done, it's kind of a trigger. Similar to a sales office, let's say in a manufacturing plant. Manufacturing plant has its own control. Just before I started the presentation, you must have heard that I was part of a greenfield project in Sri City. In 2012 and 13, when the plant was under construction, I was part of project finance. But later, when the plant became operational, I was posted there as a plant controller. There was a situation. I had not handled a plant before, and I never had a predecessor who would explain to me what needs to be done. I was clueless what to do in that scenario. This self-assessment checklist was like my spiritual book, Bhagavad Gita, Bible, Quran. It gave me what I have to do. It asked me like, have you done your variance analysis? Have you checked production variances? Have you done the labor variances? It was like a friend who's asking me to do this. When I started it, I was very religiously clinging on to this particular sheet. I started doing it, and that helped immensely. For instance, fixed assets. Are you having a conversation with your project team on the capital WIP? Is the project getting delayed for any reason? So capitalization happened as per when the assets are put to use or ready for use. Whether meeting happened every month. Are you reviewing the open GRIR? GRIR means the goods have been received and still we have not made a payment. Whether you have done that kind of a review. All these things, maybe an assessment for internal control. Also, it was kind of a guide for a person who was new. So this guides the person as well as it is kind of an assessment for them. So we use this particular checklist. We are actually empowering the unit heads to review and then also to after the review to also sign off saying this is something which we have done. And when we go in for an audit at that locations, first thing we check is see whether this thing is matching, the one we observing is matching with it. So the quality of the self-assessment can be identified. This is on the self-assessment part, how it helps in terms of identifying some gap. It empowers even the process owners. So moving on, in the earlier points I had mentioned about the areas like plant and business units and departments, activities that we review, we identify certain points. So these are observations. There is some suggestions. The auditees, when they have the closure, they agree on a date. Yes, we will do it by this time. Everything is discussed. But another important point is implementation status. On a quarterly basis, a revisit with the auditee on the points which we have observed, what has been agreed that we will be completing. If that has happened, is another particular area. It's very important in terms of getting things done. So gaps which have been identified is not the end. Whether it got mitigated and put to actual use, that particular one has been activated is another check-in point which we do on a periodical basis. Technology, we just mentioned about how technology is changing business and a lot of things have changed. So has audit also. In the last year, when pandemic struck, there were travel restrictions for audit. So we couldn't get into the business unit. Within a matter of weeks, we devised an alternative plan in terms of how this entire business unit can be reviewed remotely till the time the pandemic situation is under control, when travel restrictions are in place. We identified for physical verifications certain local audit firms who were willing to get into our location because manufacturing units were functional and all proper features were in place in those locations. And some of the places where asset verifications have to happen, we did a virtual physical verification. All that were made. We were using the SAP and other system to the extent possible to generate data which we can use it better in terms of its analysis. So along with technological change, even the audit evolved along with it to adapt to the change in the technology. Entity level control, another major and the important area. You will be aware of the whistleblower policy. The code of every company has a code of conduct, and there is a ethics helpline. Some frauds and this gets reported, and every organization has certain investigators, partly from the audit team, and also certain subject matter experts can become investigators. These investigators get into the review and they find out what has happened in that particular fraud or whatever it has been identified, that gets reported to the management. So from our team, what we do is when there is a kind of whistleblower's code of conduct violation, it's a very clear indicative of a control lapse. It's a failure in the part of it. We analyze that particular, or we take that as a source of a flaw in the system. What can be, what kind of a remediation? So this is an instance like it's been reported, reviewed, it's been, action has been taken. But from there, the learnings we take it, what better we can do in that particular area, we find it out. And on that basis, we try to strengthen the system further, the internal control further. Last point for my discussion, but not any way lesser, I would mention about the 4 C's which a finance professional, internal auditor, anyone should perform as a finance professional, what we need to follow. The first of them is credibility, credible. We have to ensure for all these things to work, we have to listen and understand the business partner properly, what they are mentioning, what is the issue in hand. Facilitate decision making. We have to facilitate based on proper listening, understanding the issue. We have to facilitate a decision making, and we have to ascertain with proper facts. We have to identify what are the alternatives which are available. So, being credible, being abreast with what knowledge we need to have, will be a very important point, because tomorrow, when the business other departments come to us for this is a very vital point to be credible. The second important point, the second C is challenge. So ask the relevant questions. When there is a particular issue or something is tabled, if you don't ask the relevant questions, you don't get into the issue. You don't get the solution. Ask the relevant questions and explore all the alternatives that is possible along with the business partner to review and to do it. That is on challenge the particular situation. Third one is on communication. Whenever such issues, gaps are identified, communicating to management, fixing it, board, all that is one part of it. The learnings has to go to a larger audience. Communicate to the entire organization, other functions, and explain what can go wrong. Organization which discusses what can go wrong is always well on internal control. Last but not the least, in terms of the 4th C is collaborate. Either it is client or being an internal auditor, working for an organization, every entity has a common goal and a growth plan. Our activity cannot be in a different tangent. It has to go in line with the entity's goal. collaboration should be we have to be a supportive persons in terms of how to achieve this particular one. If there is a gap, if there is a mitigation it needs to be done, an alternative plan, better solution, a process simplification is there, our team we have to be the collaborator to ensure that the company achieves that entity's goal. So from being a audit function, general feel is a block. From being a blocker, we need to become a collaborator in terms of ensuring the company achieves that particular growth. So I will again reiterate the words of Tiruluvar. While we have emphasized on acquiring wealth, safeguarding them, investing in a proper manner, and prudently spending are few important things which we have to follow for our company, client, wherever we are. We as finance professionals hold a very important thing, which is lamp of knowledge. So we should spread the knowledge by lighting more lamps, driving out the ignorance, the darkness of ignorance with our knowledge. That will be my ending note in this. And before I complete, we are all finance professionals. We get into a lot of stress. How canvas for a painting, a canvas is important. Our health is important. So we have to take care of our health. And that is more important. A healthy body facilitates a healthy mind. Healthy mind gives out good and proper decision. Stay healthy. In time of pandemic, stay safe. Thank you.
Thank you, Ram Prasad ji, for such a sweet and good presentation. So there are some questions. I will take those questions one by one. So there was a question from Nilakadan. His question was, strategic risk impacts 86% market share, but how much weightage company has given? Does the shareholder know, since it is now ever reported except in Emerald, if I am not wrong? Yes, you are correct. So the next question is, you have presented well that strategic risk accounts more than 80%. What are the methods to be followed to identify the risk which first line management should identify? Over to you, Ram Prasad sir.
Okay, so from internal audit perspective, I had explained to you in terms of, we'll take one at a time, the risk management part. So I have explained to you about the calendar that we have. So periodical checks, periodical reviews of area, and an open eye in terms of expecting what can happen from an external source, what kind of a fraud can happen, what is actually happening. These are some things which you have to be abreast with in terms of identifying the frauds which can come and how to protect this particular thing. As far as the communication to the shareholders, all information are concerned, internal audit is a independent function which reports into the board of directors. All the reviews that happens in a particular quarter gets summarized and we are getting reviewed by the board of directors. And by then, when you have it, these informations follow. If there is any significant deviations observed, it gets reported.
Hello. Okay. Thank you. And one more.
Hello.
Yes, sir.
Mr. Shubham, let me introduce Mr. Shubham Garg. He is presently, he's a chartered accountant. He is currently working as an assistant manager in risk advisory practice of Deloitte India. He has delivered multiple projects in development and implementation of integrated risk management frameworks across different business verticals. He had also worked closely in multiple MNCs and PSCs in delivering high impact internal and IFC audits and assisted companies with business processes and controls transformation. So he will be taking some of the questions along with CMA Ram Prasad ji, sir. So Shubham ji, you may continue, please.
What I was saying, Ram Prasad has already mentioned. What I would like to additionally, I would say that for identification, what management should identify in first line of defense is management used to do, interview with the process owners, as well as there are a couple of agreements which you can test upon, like you can take the commercial agreements as well as the procurement agreements to see if there is something risk at a commercial level. So these all things would management follow at a first instance to identify the risk, and then there will be a process level understanding as well as process level identification of risk, which Ram Prasad has already mentioned in his presentation, and I would say that these things will have an integrated impact on identification as well as assessment of risk.
Just to add one more point, Shubham, for instance, when I was mentioning about the third-party reviews, the sourcing team does a due diligence from the vendor before onboarding them. And periodically, they do a ESM audit. Every year, they conduct it. There are some SRSA audits, the social responsibility related. Whether, like, for instance, your supplier, whether he's having child labor, are they managing, or are they actually complying with all the regulations? These are periodical tests which the sourcing team, along with the audit team, does it. There's a separate team for it. They perform such kind of tests with the vendors. So not only when I had explained to you about audit, how internal reviews are in place, in addition to that, even for the external, the third-party risk, which I mentioned, such ESM audits are scheduled on a periodical basis. The top vendors are taken, and we do this kind of a review. Just
yeah. So the next question is from Vidva Mohan Agarwal. He is asking, directors who lay down the policies are well aware of the risk involved therein. As an auditor, certainly you can analyze, but auditor reporting will be always probable, not exact. In what way the auditor need to report when the events are yet to occur? So over to you, Ram Prasad sir.
So risk assessment again. I will agree with one of the points. Mostly the audits happen, it's on a happening basis. If something has happened, that is what we generally get. But there are forums where if there is a risk, risk and systems are discussed with the board of directors, but there's a separate forum for it. There's a separate committee which identifies future risk as well. So it is company to company, it differs. It depends on the quality of the board in terms of these things are getting discussed. It's well and good for that particular organization. So yes, we have a structured way of things already happened gets reviewed. In addition, any risk which the particular organization face is also will get discussed in the board meetings.
Also, I would like to add, there are two things. One is the internal audit function, which is completely different from the risk identification, though it may relate up to some extent. But like I say, even which is highlighted by Deepti in his presentation, in our presentation, she mentioned that there is one CRO who is responsible for the identification and assessment of the risk, and also report risk to the risk management committee. So when we assess the risk and identify the risk, there is a two-way approach. Looking at the risk from a management level and as well as from the from the third party level. So when we are assessing the risk and we are identifying the risk, we have to we should not say that ideally it's a part of the auditor only. It's a first, it is the part of the management responsibility, and second, it's it is the responsibility of auditor up to some extent to identify those risks and based on facts, yes, and to report in his audit report. The next question, I believe, is the last question. It is from Subramani. He is asking, what were the 3 main problems that pandemic threatened to affect your organization? In which all areas, how did you overcome them? Since process owners are loath to accept any material deficiency in their domain, what were the measures you successfully adopted or employed to persuade auditees to accept your findings and suggestions? Over to you, Ram Prasad.
Okay. During the pandemic, when the risks which we discussed were more general, but to be precise with any of the organizations, the main, when I would say some were external, like for instance, your customer, the dealers, were in a red zone, where there's a restriction in terms of movement. So distribution of goods in those areas, serving your consumer was a big challenge. And this must have been faced by any of the FMC organizations. Then on the business continuity part, the zone in which one of our manufacturing site was, just next to that, there was a health center. And that health center was identified as a COVID center for that entire district. So because it was a COVID center, that entire area got cordoned off and we could not manufacture from that particular location. I would just say these 2 major reasons. So in the case of first, we have seen alternative arrangements, the app-based things like Dunzo, Swiggy. We had a lot of such places where we had empaneled them to deliver. And in terms of this manufacturing site, we do have a fallback. And Colgate is one of the organizations which had, for years had been a pioneer in terms of the IT and the supply chain network. So we had an alternative location from where we had to source the material. We had to, top up the production volumes at that location, and we could do it. So these are the 2 major ones, I would say.
Yeah. And also, I would like to add, since there were multiple companies where supply chain management was disrupted, because there were a couple of companies where single vendor was used, or I can say single source vendor were used, and they were procuring from China. And due to this pandemic restrictions, they will not be able to procure and fulfill their domestic demand as well as international demand. Even if they were in come under essential services, but due to having single dependency on the sole supplier, they would not be able to fulfill their task. Also, I would say not only supply chain was disrupted, your commercial side was also disrupted, because in some of the areas the transportation was limited, and you will not be able to service your customer due to travel issues in case of BPO and KPOs, and there were other factors such as agitation by the worker due to non-payment of their salary or wages. So these kind of issues that company has faced, because they will not be able to identify those risks in the preceding years, or I would say they have not given that much stress to their strategic area. Like Deepti mentioned that 86% of the risk were strategic risk, and only 6% of the effort is being given to that particular area in terms of identification and assessment. So yes, I would say that the company who is more resilient in identifying those risks will succeed in the near future and will have a you can say best approach while dealing with these type of situations. So this was all the questions that we have. I would like thank all the panelists and Arun, Ram Prasad ji, Deepti, Santosh, as well as Amit to be part of this amazing webinar. So over to you, Arun. Okay, so we can conclude this webinar after taking inputs from Amit Kumar. Over to you, Amit sir.
Thank you, Shubhamji. First of all, it's a very nice deliberation by all the speakers today, and it's a very good learning to all of you. So, thank you all for all the experience shared by the faculties. So it's a very good session for all. So thank you to all of you, the participants, for patience, hearing, and participation. So over to you, Shubhamji.
Thank you, everyone. So we can conclude this webinar. Thank you, everyone.
Thank you.
Have a good night.
Good night.